Welcome to this lecture on transfer pricing, and in this lecture I wanted to take some of the material we've presented in earlier videos about the economics and the microeconomics of a firm in perfect competition, and then show how that helps us reach some of the answers we need to reach in transfer pricing. So I sort of think of this as the economics crossing over to the finance connection in transfer pricing. So a quick refresher about where we were with the competitive equilibrium. If a competitive firm in equilibrium, that firm faces a demand curve that is essentially a flat line. It's not big enough in the marketplace to affect price. It can sell whatever quantity it wants to, but at the going market price, if it tries to sell more, it won't cause the price to fall. If it tries to sell less, it won't cause the price to rise. So in this case, you can see our line, demand curve is a flat line at the going market price, and that means your price equals your marginal revenue. And we've talked about that the average cost curve of a firm would be a sort of U-shaped curve. Initially, there might be some economies of scale, but quickly those are going to go away, and the curve is going to be upward sloping as you have diminishing returns as you try to produce more product. And then we've talked in earlier videos about the marginal cost curve, and this is the cost of producing the very next unit. That the next unit you would produce would cost this much more, and as you can see, the marginal cost curve is going to cross the average cost curve at its lowest point, which makes sense. The minute the marginal cost is higher than the average, it's going to be pulling the average up. When it is below the average, it's going to be bringing the average down. So this may be familiar to you from the earlier videos. And you can see at this point, this is what we think of as an equilibrium situation for a firm in perfect competition. At this particular point, you can see that their average cost exactly equals the price that's being charged, and therefore there's no economic profit being made in this system. If you tried to produce at any other level, produce less, produce more, your average cost would actually be higher than the price you get, and you'd be losing some money. If that were to happen, people would exit the industry and the equilibrium price would adjust such that in equilibrium, this is going to be a stable situation. Now, as we go on from here, it's important to remember that economists treat the return to the entrepreneur for the risk that they're taking and they're in the business venture as being a cost that's got to happen. So, and that's going to be very important to the rest of our discussion. So I just wanted to bring that point out, but that this is the economics sort of view of a firm in equilibrium in a perfectly competitive environment. Now, um, as we move on from here and say take a look at how we go, right now that we've got this equilibrium position, I want to now present this from a different viewpoint, and that is of looking at the total revenue and the total cost lines. Now, the total revenue line is essentially going to be a straight line, and that's pretty straightforward. I can sell another unit of product at the same going market price in perfect competition. I can't affect the price. So whatever the price is, every quantity I sell here, which is moving me out the horizontal axis, the revenues I'm going to receive are going to go up by the fact that I'm selling one more unit. So very straightforward, straight line going up. The cost curve is going to have a bit of a different shape. Remember, the average cost curve was U-shaped. That means when you start to talk about the total cost curve, you're going to get a bit of an S-shaped curve to it. If you want to think about this mathematically, if your cost curve were a parabolic function, a quadratic function, something to take the average cost and go on up to the total cost, you'd multiply your average cost at each place in time by the number of units you're selling. So multiply it through, so that quadratic equation would become an equation with the cube term in it. And that gives you this sort of S-shaped curve. And I've drawn it here to show a point where they're going to just touch. At that point, that's the equilibrium. That's the same equilibrium point we had for quantity in the earlier diagram. And think about it. This is where total revenue exactly equals total cost. Well, that's going to match up perfectly with where average revenue or the average cost equaled the price. The price is the average revenue in this case. So we're going to have that same equilibrium point. Now, with that said, let's think about this concept that an economist uses the term total cost. They're including that return to the entrepreneur for entering into this business. And let's draw on a dashed line that is going to be below our total cost line. And that's going to be the total accounting costs. And that's going to help us sort of keep track of this a little bit in this sort of presentation. So now we have a sort of total accounting cost of doing it. The difference between those two is that amount of profit that a reasonable entrepreneur is expecting to earn just to be at that sort of break-even concept in perfect competition. Great. Now where are we going to go from here? Well, in transfer pricing, the key issue is going to be is that the taxpayer is going to be buying or selling to a related party, and we're trying to make sure that the price in that transaction is arm's length. It's what two parties would have charged each other if they weren't related to each other. And let's assume that that transaction is taking place in a competitive marketplace. What we would want is a price that would be equal to the equilibrium price. And we're going to discuss this from a couple of points of view, from the point of view of someone selling to a related party and someone buying from a related party. Let's go through our example a little bit more. So here we are, we're going to talk about the concept of, suppose that this is the curves and the situation facing company X who is selling to a related party. Now, what can we absolutely observe in the real world of finance? Well, some of these things are sort of contextual. We don't really know what they are. For example, if we're selling to a related party, then that total revenue line, that price that we're selling it at, we don't really know that line. That's the line that total revenue is what we're trying to figure out what would be arm's length. So let's get rid of the total revenue line. And in the real world, we don't observe the total cost line. That's an economic abstract, quite frankly. So let's get rid of that total cost line. And now we're down to the total accounting costs. Well, we don't actually observe the curve, do we, in the real world of total accounting costs? What we really do is we observe what it is at a point in time. You know, we might have a few years of data, but we really just have one point. So we're going to erase the curve and just have that one point in time where we can actually say for our company X, we do know our costs because our costs are things we bought from people who are unrelated to us. So those are marketplace costs. We're selling to someone who is related, and that's the thing we don't really know, and we're trying to determine what would be an arm's length price there. I mean, we may have something on our books and records, but the whole point of transfer pricing is to validate whether that amount is the correct amount. So what are we going to do? How could we estimate what the amount might need to be? Let's suppose that we know our own costs, but we don't know what our revenues should really be. We need to find some spread between, how much more above our costs would our revenues be in a sort of normal situation. And let's suppose that we did know of another firm, a third bullet point, that bought and sold to unrelated parties, and we could take a look at their financial statement. What would that look like? If we thought of that party as operating in a competitive situation, then we've drawn their curves over here on the right-hand side of the screen. They're buying and selling to unrelated parties. But again, we're not going to observe all of these things in the real world. What's going to be missing here? Well, we don't really observe that total cost line. Again, that's an economic construct. So let's take that one out. We don't actually observe the curves here, right? We can see what their total accounting costs are and their revenues are at a point in time when they publish their financial statement. So we're going to get rid of those curves. We're going to say we have these two data points. We know their total revenues, TR, and the total accounting costs. And I think this should start to look interesting because this is starting to look a bit like a financial statement. But let's think about here now what we want to determine. Here's what we know. We know with an uncontrolled firm, we can observe the total revenues, we can observe these total accounting costs. And then we've got to remember that what are we doing here with our related party? All we have with the related party is the total costs. Now, what we're trying to determine is what their total revenue ought to be. Well, what we can do is we can extrapolate that the amount of profit that was being earned in the uncontrolled transaction, right, that unrelated firm, that uncontrolled firm, is a way to take that profit and say if the related party here, our company X, earned that same profit level, we'd be able to estimate then what their total revenue would be. And that's where I drew in that star in light blue. Now, this is starting to look a lot like two income statements next to each other, but the one is missing some data. Now, our unrelated party that we've got, we can observe their full financial statement. For our related party, in general, what we have is we may have a financial statement from them, but what we have a concern about here is we don't know with certainty whether the number in one category is absolutely right. Say, in this example, we're saying they're selling to related parties, therefore that revenue is kind of the unknown. But if we knew the profit and they were absolutely identical, we could take the profit of the unrelated party, add it to the total costs that we can observe for company X, and back up to, well, what would the revenue have to be for that to be in balance? Now, what's important here is now the next step is that it's going to be almost impossible to find two companies that are absolutely identical, that would have the exact same amount of costs. So we're going to have to do this by thinking of it much more as a proportionate thing. Uh, and that would mean to say that if company X, how much profit should it earn in proportion to its size? And we might use something like, well, these two companies at the end of the day should have the same return on assets. Or maybe they should have the same operating margin. Or we think maybe they should have the same gross margin. We have a few different ways we can think about this problem. And we'll talk more about which way you might pick there in the future. But right now, let's just think about all of them as being, potential cases, and we can think, how that's going to work out. Well, let's flesh out what the income statement would actually look like for these two entities. And I've noticed I put down assets down below so that we know that may be a value that we need. And if we have this information, what we can think of is that, well, we've got all of the information we know for the unrelated party. We could use that to say fill in all of those missing things for the company X. Now, what we're really trying to nail down here is what that revenue number should be, right? The other two are, margins that we can potentially say, well, what if we earned the margin that the unrelated party earned? That might give us a way to calculate what our revenue number needs to be. So let's take a look at that mathematically. If we were to take, say, the ROA from the unrelated party, and then we multiply it by the assets of company X. So we're taking the ROA from the unrelated party, we're going to multiply it by the assets of company X. That's going to give us an operating profit, right? We're going to define the ROA here, which is a little different than what you've seen in most analyses. But we're going to use the operating profit relative to the assets as opposed to the net income relative to assets. And the reason for that is I don't want my answer to be distorted by whether the company has got a lot of interest expense or no interest expense. So I'm going to do my analysis at this operating profitability point of view. And once I know that operating profitability, and I do know the SG&A, the selling and general and administrative expense, and the COGS of this my company X, I can add those three things together to say, well, then the revenue would have to be this number so that at the end of the day, they make this profit. And that's all that goes into this. The revenue is what we're trying to determine. That's we've set this whole problem up saying is that company X is selling to a related party. So we got to figure out whether they're getting the right amount of revenue when they sell to that unrelated party. We could do the same math, but we could modify it and instead use something like the gross profit margin or the net cost plus markup on total costs, which is somewhat similar to an operating margin. There are different ways to sort of approach this problem. And of course, if we were using, say, the gross profit, then we'd want to multiply that times, I'm not sorry, if we're going to use the net cost plus markup, then what we'd want to do is say, well, then that's the return we should earn on all our costs. Well, we know all our costs. We know the SG&A and the COGS. We add those two together and we say if the unrelated party earned a markup of operating profit over the cost base of, say, 5%, then we'd want the same 5% return to be earned by company X. That gives us a way to fill in these numbers. But remember, if we're changing this profit measure, we have to change what we're multiplying it by so it makes mathematical sense. Let's talk through this problem one more time, but this time instead of thinking about the related party selling to someone, we're going to have the related party buying from someone who's related. Same math, and it's really, I'm just going to walk through the whole thing over one more time so that you sort of see how this operates and what's going on. So again, start off with this equilibrium as stated in the total costs equaling the total revenue lines using that economics version of total costs. What do we know? Well, we know that total costs aren't taking into account all of those. I'm sorry, the total cost is giving a return to the entrepreneur, and that the accounting costs are going to be something less than that because that's going to be less that return. We don't actually observe all of that total accounting cost line, so we've got a point that you're buying from a related party, so you're not even really sure you know your COGS well here, right? That's where your related party transaction is affecting your income statement. You're buying from related parties. So let's get rid of that accounting cost line and say that's we're not so sure of anymore. Also, we know that we don't actually in reality see a total cost line. It's the economic abstract, so let's just get rid of that. What we have then is a total revenue. We don't have the total revenue line. What we have is an observation of how much revenue we earned. So we have a point. We know how much revenue we earned. And that's revenue that we got by selling something to unrelated parties. So that's known, right? There's no uncertainty of that. Where our uncertainty is all about is the cost of goods sold because we bought our goods from a related party. Well, if that's the case, then we're going to say, we're buying from a related party. We're going to have to determine what that should be. And suppose we could find another firm that bought and sold to unrelated parties, and we can take a look at their financials and their financial statement. So again, we're going to look on this other side. We're going to say, well, suppose this is the same structure for an unrelated party. But what do we actually observe? Well, we don't observe the total cost curve. Again, that's the economic abstract, so we're going to erase that off. We don't actually observe the total accounting costs curve, but we do observe one point in time as to where that is. And we don't observe that total revenue line, but we do see what the total revenue is of this other firm. And we say, well, at that point in time, this other uncontrolled firm, which sells to unrelated parties, we know their revenue and their costs. And again, we're going to use that for solving the problem of what should the transfer price be. So here's what we know about the uncontrolled firm. We know their revenue and their costs. And then when it comes to our company X, what we do know about them is that they're selling to uncontrolled parties. So we know their total revenue. What we don't know is what their cost should be, right? But we can see that we think it should be in parallel to what the uncontrolled firm has. We could extrapolate that profit that should be earned by the related party by using the profit that an unrelated party earns as an estimate. Now again, this simple sort of view is that they're identical in all ways. And we know that that doesn't really happen all that often. But if we were identical, we'd be able to just say, well, if our revenues are known and our profit could be estimated from this other company, then we'd say, well, then the difference here needs to be that cost. And that would become the number that we would be able to fill in to say, here's how we solve the transfer pricing problem. And if we say, but if these companies weren't identical in scale, then we'd have to worry about whether maybe we've got to take into account, measure all of this proportionately. So again, we could solve this problem by thinking about the return on assets or an operating margin or maybe the gross margin as a way to solve this problem. So let's go through that. We're going to develop this financial statement here for our company X. And remember, the thing that we're uncertain about is the COGS because we buy from an unrelated party. I'm sorry, we buy from a related party. That's why it's got a big question mark on it. And so what we're going to do is fill this in going up. And in that case, we're going to try to determine what those COGS should be. And this time, I'm going to use the mathematics as if I'm using the operating margin. So I could take the operating margin from the unrelated party, that party on the right-hand side of the previous slide. We're going to multiply that by the sales that company X has, because those sales are to unrelated parties. So we know those are solid numbers. And we'd say multiply those two things together, and that tells me how much operating profit company X should earn. Well, if I know their revenue and I know the operating profit, I could subtract that off. That would tell me their total costs. And I know their SG&A because that's stuff that they're buying from unrelated parties. It's only the COGS that I think are the related party transaction. So I can subtract off the SG&A, and what would be left is the COGS. So that gives me a way to estimate what the COGS should be for this related party. So that's what we're trying to determine. The COGS that company X should pay to its related party for the goods it's going to receive, and then it's going to resell those on to unrelated parties. So they're acting probably in the function of a distributor. We could also solve this problem by, say, doing the same mathematics, but using, say, the ROA as we did on the earlier example, but multiplied by the assets to come up with what the operating profit would be. Or you could use the gross margin, which again is, remember, that's going to be looking at the gross profit over sales, and say if I took the gross profit, gross margin, and multiplied it times their sales, I'd be able to fill in what their um, gross profit should be. And the difference between sales and that gross profit would be the COGS. And since we already know the SG&A, we can then calculate what the operating profit should be. So there's a way for us to fill in all the missing cells in that table, sort of thing, by extrapolating the data from the firm that we have found that we think is very comparable and gives us a good reference point. So your assignment then is going to be essentially a class assignment. Each person everyone in the class is going to take the financial statements for Arrow Electronics for the year 2015, and that is going to be our related party. We're going to make the assumption that Arrow purchases all of its COGS from a related party, and it's reselling them to unrelated parties. And then each student here is going to have a different unrelated party to use as a reference point. So you have to look to the Canvas site, and I'll list it there who's using what, and we'll post up all the financials so everybody has them or has a way to get to them. And you're going to estimate what would the arm's length COGS be for Arrow Electronics using your unique unrelated party. I have to correct that slide. So you have a unique unrelated party. Everybody has the same related party. And you're going to calculate it three ways. Since they're a distributor, it's going to be easiest to think of this as calculate it using their operating margin, their gross margin, and their ROA. So you'll have three different approaches to this problem. And you'll calculate what you estimate the COGS should be. And then I want you to calculate what is the difference between that estimate and what the actual COGS of Arrow Electronics is. Because remember, one thing we do know about Arrow Electronics is that it's a public company and its financials aren't actually influenced by arm's length issues. So we can tell how accurate this method is by seeing how close we can get to the actual number on the Arrow Electronics financial statement. So I hope that lecture has been clear. I'm going to post up the assignment shortly, and I hope you enjoyed doing it. And then once we get all the data in from everyone, we're going to see how wide the range is of answers. Thanks, and have a great day.